Welcome back, everyone. Thank you for tuning in. There is a very good saying, the worst mistakes in life are the ones that we never learn from. And I realized that it may be a bit of a sentimental start to a video on economic sanctions, but I feel that the saying does an excellent job of describing this continuous spiral of following the same exact policies that have already led to countries abandoning what once was perceived to be the safest investment, U.S. Treasuries, as well as the United States dollar itself. For example, in the first quarter of this year alone, China sold $53 billion worth of U.S. Treasuries. As we know, it continues to buy gold and other precious metals to replace those reserves. Yet on May the 14th, the Biden administration announced a series of heavy tariffs that are now imposed on goods made in China. What's very interesting is that here in this post on X, they only mention a 25% tariff on steel and aluminum, a 50% tariff on semiconductors, a 100% tariff on EVs, which I don't believe are available on the US market anyway, and a 50% tariff on solar panels. And the post itself ends with a quiet, let's just call this surprising, shall we? Quiet, surprising statement. I am determined to ensure America leads the world in them, in those industries, that is. We'll go back to that statement in a minute, and I will prove to you why it's actually completely off, the statement is completely off, and these tariffs will achieve the exact opposite. But to begin with, there is a wide range of goods from China that will now be increasingly more expensive for U.S. consumers as the result of these tariffs. And this includes face masks, battery parts, medical gloves, syringes and needles, and critical materials, to name a few. After multiple unsuccessful attempts to force China to address its overcapacity, quote unquote, the government resorted to what it knows best, to sanctions. And of course, to be absolutely clear, by overcapacity, what we really mean is efficiency in manufacturing that Chinese companies managed to achieve. To put this very simply, the main two reasons why these items are imported from China and to other countries, specifically into the United States, the main two reasons is because the cost of labor is much, much cheaper in China, and the availability of labor in China is much higher. So those two favorable factors combined allow the end consumer to buy these products at an affordable price point. If you hike tariffs on these items, you obviously aim to discourage imports, that is absolutely clear, but you also hurt an average consumer who will now have to pay a lot more for the same exact product, for the same exact item. What about domestic producers, you should ask? Well, domestic producers are not able to manufacture the same products at these affordable prices for a variety of reasons that range from much stricter government regulations to higher labor costs. The majority of U.S. producers are not exactly very competitive internationally, unfortunately. Again, that is a very simplistic way to describe this, but the bottom line is that when we see statements such as these tariffs were put in place to ensure America leads the world in these industries, when we see something like that, it is important to understand that this is nothing short of being the pinnacle of hypocrisy.
American workers can outwork and outcompete anyone, as long as the competition is fair. But for too long, it hasn't been fair. For years, the Chinese government has poured state money into Chinese companies across a whole range of industries: steel and aluminum, semiconductors, electric vehicles, solar panels, the industries of the future, and even critical health equipment like gloves and masks. China heavily subsidized all these products, pushing Chinese companies to produce far more than the rest of the world can absorb, and then dumping the excess products onto the market at unfairly low prices.
It is very well known that tariffs raise prices and reduce economic growth. For example, the taxfoundation.org actually published a report with its assessment of the impact of U.S. tariffs and other actions aimed to retaliate. Its key findings indicate that the tariffs put in place by President Trump and President Biden, and this is as of 2023, so it doesn't account for the latest sanctions, those things will ultimately reduce long-run GDP, they will reduce wages, and they will reduce full-time employment numbers. The report goes on to say that economists generally agree free trade increases the level of economic output and income, while conversely, trade barriers reduce economic output and income. Historical evidence shows tariffs raise prices and reduce available quantities of goods and services for U.S. businesses and consumers, which results in lower income, reduced employment, and lower economic output. So to sum this up, the net impact of these new tariffs on Chinese goods will hit American consumers, who will experience lower income, lower employment numbers eventually, and in general, the GDP will be lower as a direct result of the tariffs that the administration announced this week and previously. Now, I would like for you to pay very close attention to the next paragraph because it does an excellent job of spelling out exactly how tariffs hurt consumers. Tariffs could reduce U.S. output through a few channels. One possibility is a tariff may be passed on to producers and consumers in the form of higher prices. Tariffs can raise the cost of parts and materials, which would raise the price of goods using those inputs, which is exactly what will happen here, and reduce private sector output. This would result in lower incomes for both owners of capital and workers. Similarly, higher consumer prices due to tariffs would reduce the after-tax value of both labor and capital income. Because higher prices would reduce the return to labor and capital, they would incentivize Americans to work and invest less, leading to lower output. Alternatively, the US dollar may appreciate in response to tariffs, offsetting the potential price increase on US consumers. So that sounds great on the surface, doesn't it? But there is a trick. The more valuable dollar would make it more difficult for exporters to sell their goods on the global market, resulting in lower revenues for exporters. This would also result in lower U.S. output and incomes for both workers and owners of capital, reducing incentives for work and investment and leading to a smaller economy. The current and the previous administrations imposed multiple rounds of tariffs, and it is safe to say that if the first round didn't work, perhaps it's time for them to change their strategy and admit that their old tricks just don't work anymore, and in fact, they come back to haunt them. In fact, they do work, I should say, but not in favor of the United States. Or maybe this is just part of the plan to continue destroying the economy and to continue destroying the country from within. Let me know what you think about this. Let me know what your take is. As always, I would love to hear from you. Thank you for watching. Thank you for taking the time to join me. Please like, subscribe, and share. It goes a long way. I would love to have you back for my next one tomorrow. And if you enjoy reading, make sure that you find me on Substack, where you can now find posts as well as podcasts. So I will see you back here tomorrow. Have a great rest of your day. Take care.